Nifty and the sensex open with sharp cuts as the US Fed's hawkish outlook for 2025 weighs on the market. IT and metals are the biggest losers so far.
Asian Paints is down 2%, declining to its lowest level since April 2021 on the back of two leadership exits. Both Vishu Goel as well as Shyam Swamy cite personal reasons as the cause of their exit.
Dr. Reddy's Laboratories buzzing in trade after a Nomura upgrade coming in. They've upgraded the stock to buy from a neutral call with a target price of 1,500 rupees.
DOM slips nearly 4% after 4.5% equity changes hands worth around 808 crore rupees. The change of hands happens at around 2,899 rupees. Sources say that Fila is likely to be the seller.
CNBC-TV18 News confirmed as Zagil launches a QIP with an issue size of up to 750 crore. Sources say the indicative price is set at a 523 rupees a share, stock down nearly 2.5%.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. With me is Mangala Malu. And as we speak, well, as you can see to the top of your screen, the markets are still in the red. However, the good news is we've seen a bit of recovery from the low point of the day. And Mangala, I'll tell you what, the bulls will be clutching onto these data points. They'll be hoping that in the near term, we could see some bit of oversold levels. And that's why we're seeing a bit of a bounce. But I'll tell you what, more than the Nifty, what is impressive right now is in the first 10 minutes of trade, the advance decline ratio had only around 160 stocks that were advancing. That number has moved to around 650. So let's see whether or not the breadth of the market can improve. For the time being, at least those crisscross lines are getting a little bit closer to each other.
We're seeing that in a lot of individual stocks as well. You know, this morning, if you look at something like a Trent, it had been weak over the last couple of fortnights, and now it's coming back once again. So Trent's moved to the high point of trade. Lower oil prices overnight meant that some of these refiners could do well. So BPCL is higher, oil marketing companies. So just keep an eye out on BPCL. And then you also have Castrol, which uses crude oil as an input. So we'll keep an eye out on that one. That too has moved to the high point of trade. And seeing some traction on a couple of names like 63 Moons, etc., which continue to do their up move. This week itself, the stock is up around 20% So a bunch of stocks doing well. Swiggy, for instance, continues to move higher, closing in on a record high level. And Shoppers Stop too. Yesterday, Amazon sold their 4% stake, so maybe the supply overhang having gone away has taken the stock higher by about 2.5%. So a bunch of stocks which are advancing in an otherwise gloomy market. The good part is that the Nifty is held on to that 200-day moving average a little over that 23,800 mark itself. So let's get in Vinay Rajani of HDFC Securities for a quick technical check on the market. Vinay, we've made the lows of the day. Do you think we will revisit that and go perhaps lower? Or maybe for now, the 200-day moving average remains an important support zone to track?
Yeah, good morning, Mangalam, and thanks for having me on the show. So definitely there was a support at 23,900, which happens to be the previous swing low, and this low was made on 28th November, and today's low is exactly around that level. 23,870 is a low, and the put call ratio at the beginning of the day was 0.55. So after the opening, that put call ratio, which was oversold, has actually seen a bounce. Now it is currently placed at 0.65. So after a gap down opening, the put call ratio started rising. That means more puts have been written than the calls. That's a good sign. So we may expect an intraday recovery from here. But yes, yesterday we saw a short build-up in the Nifty and Bank Nifty both. So positional trend could remain down. On the higher side, 24,100 is a strong resistance, which is derived from the downward sloping trend line, which was acting as a support previously. Now it is expected to act as a resistance. So 24,100 is a strong resistance around which I think intraday traders should exit the long positions, and uncertainty will remain there because it's an expiry day. And last 4 days have been a bearish for the markets. So overall, I feel that intraday bounce could come, but traders should exit the long position around 24,100. And at the lower level, if today's low is again broken, then we can expect a next target of 23,700. So it's a conditional buy or sell, but yes, there could be a pullback rally in the intraday up to 24,100.
Got it. Okay. All right. Vinay, good morning and welcome to the show. You've given us a view on the index. I think you're saying the trend still seems to be weakish, but don't rule out a bounce from these oversold levels. Tell us about individual stocks, though. What are the trades you have for us?
Yeah, so in this kind of scenario, I think pharma sector can outperform. So one of the stock which is looking very strong on the chart is the Torrent Pharma, which has given a breakout from the consolidation. So Torrent Pharma can be bought around 3,400. Stop loss can be kept at 3,325, and upside target can be kept at 3,525. So this is a 1 or 2 days trade. And another trade I would like to go for is the short side. So Axis Bank closed on a weaker note yesterday, and today also it is showing weakness. So Axis Bank December future can be shorted around 1115, and stop loss can be kept at 1135. On the downside we can expect a target of 1085. So one long on the in the Torrent Pharma and one short in the Axis Bank December future.
All right, long in Torrent Pharma, short in Axis Bank. Just keep an eye out on India VIX now. That's moving lower as well. So that's a positive sign. The market's recovering from the lows of trade. Broader markets doing a lot better. And the India VIX coming down along with the put-call ratio improving to 0.65 versus 0.55 has been put out as well. So those are a couple of factors we'll keep an eye out on. But speaking about ideas for profit coming in from our colleagues at Money Control Pro, let's get you one with Khushbu Rai, who joins in to talk about a stock.
In today's idea for profit, we have Home First Finance Company. Home First is a technology-driven housing finance company that operates in the affordable segment, targeting first-time home buyers. The company aims to keep its productivity at par by using tech and digital innovation. If we look at the recent earnings, Home First has been a consistent performer despite intense competition. In terms of scalability, the company has crossed key milestone backed by buoyant demand from Tier 2 and 3 cities and strong policy thrust. The company is gearing up for future growth with increasing penetration in core regions and addition of new territories. Also, more co-lending tie-ups and increase in ticket size will drive asset growth in the coming period. Moreover, the company expects a meaningful impact from Pradhan Mantri Awas Yojana CLSS scheme in FY25. We believe that affordable housing sector will be a key focus area of the government. Therefore, Home First will stand to benefit given robust loan growth and stable asset quality. Investors should consider adding the stock on dips with a long-term view.
All right, with that, we'll take a short break. Come back on the other side. We'll focus on the primary markets. Paresh Dattani, Chairman and Managing Director, and Sameer Dattani, who's the Director at Sanathan Textiles, joins in to discuss their IPO that opens today. Hello and welcome back. You're watching us here on Chartbusters. Let's shift focus to the primary market action. Yarn manufacturer Sanathan Textiles 550 crore IPO opens for subscription today, closes on the 23rd of November. It's 400 crore of fresh issue, 150 crore of offer for sale. We do have Mr. Paresh Dattani, who's the Chairman and Managing Director of the company, and Sameer Dattani, who's the Director of Sanathan Textiles, joining us in the studio. Thanks a lot, gentlemen, for joining in. Welcome to the stock markets, as they say. The important part, while you have you raise the money that you do, you have a lot of responsibility towards your shareholders, etc. as well. Two things in particular I want to ask. From the 400 crore rupees that you're raising, about 300 crore looks like it is going towards debt repayment, and 100 crores is for general corporate purposes. So the obvious question is, what is your consolidated debt right now? How much does it reduce by? And 100 crores in general corporate purposes, can you specify? Because 25% of your offer for sale going in for general corporate purposes is something that the street wants clarity on. How much will you spend where?
See, we have a 400 crore primary issue. Out of that, 300 crores we'll be paying back the debt. The peak debt that we'll have post the expansion that we are on, we are more than doubling our capacity. Once that comes into post, the peak debt will be about 1,400 and odd crores. We'll be paying up 300 crores, so we'll come to a peak debt of about 1,100 crores.
Okay, all right.
And the general corporate purpose expenses, we'll be using it mainly to fund our working capital margins.
Got it. All right. Welcome to the stock market, guys, and thanks a lot for coming down to the studio. So you'll have 1,100 crores approximately of consolidated debt post this payment. So your rough interest cost outgo would be at a percentage of what, 7 to 8% is what you're borrowing? So it'll be approximately
about 75 to 80 crores.
75 to 80 crores.
And when does the debt peak? As in, where do we see the peak debt numbers reflecting on your books?
Peak debt numbers, once we commission the plant, this will be, it'll be coming in the first quarter, FY26.
Got it. All right. Hi, Sameer. Welcome to the show as well.
Hi.
Tell us, in terms of capacities, You're going to be doubling your capacity, I understand. As of last year, you did roughly around revenues of around 3,000 crores. If you're going to be doubling capacities and you're functioning at optimum levels, is there a potential that your revenues as well, optimum levels, you could do double the revenues, which effectively would be that around 6 to around 7,000 crores?
It makes sense, right? Because our current yarn capacity is 223,000 tons per annum.
Okay.
And over the next 3 years in a phased manner, we will be at 550,000 tons plus.
Okay.
And all of this expansion is planned. It's on ground. The first phase will start in April 2025.
Okay, so you're saying that, you have the potential, but do you think demand will be such that you could move towards that peak revenue number that you're talking about?
So there are two factors. First of all, the India demand is growing. The textile industry, as reported, is expected to grow at a CAGR of 7%. There is a massive PLI incentives the government of India has given. And all of that is mainly for downstream, for our customers, the fabric and garment manufacturers. Now, all of that will require a lot more yarns. And let's not forget, we have the Bangladesh opportunity for the Indian textile industry, which I think we will be able to convert. And plus adding to more exports of garments and fabrics requiring more yarns.
So, two factors to that. You said one is the strong demand from the end users of your products. And secondly, the opportunity is coming by. With you actually going ahead and increasing your capacity, there would be some operational efficiencies that you would generate as well. And the value-added products, which I see at around 50% of your overall sales. If you could give us a sense on your margins, because I look at your margins, they're all over the place. FY22, they were around 17%. Last year, they ran down 8% with increase in value-added products, increase in capacity, etc. What is the sustainable margin that one should look at? Revenue, you've told me approximately, it could be close to around 6,000, 6,500 odd crores. What is the margin that everyone should work with?
See, we have consistently, if you look at 3 years, 5 years or 7 years, we have done about 10.5 to 11% EBITDA over the last 3 to 7 years average.
Yeah.
We don't look at it year-wise because post the COVID, the pent-up demand, that was 1 year, and then the geopolitical situations impacted the margins because of the exports. But over the last 3, 7, 10 years, we have consistently done 10.5 to 11% EBITDA.
So that should be more realistic. The 17% was an aberration, and on the downside, even 8% is an aberration.
I must tell you here also that with the expansion, we are going closer to the consuming centers.
Got it.
And we're going to be, at the moment, the only supplier there locally there.
Mangalam also asked you about, value-added products as a percentage of the total mix. Where do you see that number headed? And also, geographically, how do you see things change? I think exports are still smaller. Do you see a potential of that as well going up? So percentage on both VAP as well as exports.
Our exports have typically, over the years, ranged between 5% to 16%. This we move according to better netback margins. If we get better netback margins locally, we move here. We are not in a compulsion because we were stressing our assets fully. We were in a sold position. We didn't have material to supply. So that choice we always had to move whichever way we wanted.
Just a final question. You did say that your volumes would increase by a certain amount when your capacity increases. I'm just looking at it from a simple, this is the money that I put in and this is what I get in terms of return. So your capex plan is close to around that 1,800 crore mark.
That's right.
Typically, what is the asset turn on a business like that?
On an asset turn of polyester filament yarn, it's about 2.1 to 2.2 asset turn. And the cotton yarn gives you an asset turn of 1 to 1.1.
So roughly, this implies a revenue potential of 3,600 odd crores?
In the first phase. And overall, when we complete all the all the phases, it will come to about 4,400 crores revenue.
So currently, you're doing about 3,000 odd crores, right. 4,400 crores. Say 3 years from now, we're looking at revenue of almost $1 billion with 10% margins. Is that a possibility?
That's a possibility.
Okay. Very quickly, what about your return ratios? What is typical ROC you'll work with?
Over the years, we have consistently got ROCs of north of 20%.
Okay. And, from a stock market perspective, they are a little uncomfortable with companies having a large debt. So do you think with the cash that you will generate over the next few years, you'll be able to repay this debt down from around 1,100 crores? Will the aspiration be that, say, in the next 4 years, that you'll virtually be debt-free? Could that be the direction?
Oh, if you look back at our history, whatever debt we have taken, we have always prepaid the debts and never restructured any debt. And this debt also, we intend to pay it off earlier.
Okay.
All right. Also, I would like to add, even at the peak debt, our debt equity will be at about 0.7, 0.8.
We'll hold you all to some of these numbers. And on listing, we request you all to rejoin on the channel and, in fact, give us more concrete numbers. But all the best, gentlemen. Thanks a lot for coming
Thank you very much.
Thank you
to the studio as well.
Thank you.
For the time being, though, I think we'll slip into that short break, come back, continue our focus on markets and stock-specific action. Welcome back. Well, the markets are still down, recovered a little bit from the lows, but from the broader markets, plenty of stocks are doing well. Pull up Stovecraft. That stock has moved to the high point of the day, and for this week itself, it's done quite well. Keep in mind, it's been a relative underperformer post its listing because the stock nearly doubled, and from there it saw a sharp correction, but now it's pulling back in style at around 915 rupees. Vascon's another stock that's been an underperformer, but that as well has seen some kind of buying from around that 50-51 rupee odd mark. So keep an eye out on that stock as well. Vascon is the stock that we're talking about. And NMDC got smacked yesterday. The street seems to be wondering whether or not, what the Karnataka government is saying, whether it can be rationally implemented, because otherwise the miners make no money. For the time being, the stock is up 0.5%.
Keep an eye out on a couple of these other stocks as well from the broader markets, like you spoke about. AGI Greenpack is one. Opened with a sharp cut. From there, that dip was bought into, and it's recovered about 8% from the lows. So AGI Greenpack currently at the high point of trade, sitting with a gain of almost 2%. It's been a good month for them, up around 30% in this month itself. The other one is Zinka Logistics. Recent listing. This month itself, the stock is up 80% from its issue price or opening price itself. And now currently sitting with a gain of almost 8% and 5-star Business Finance. That's another recent listing that too has moved to the high point of trade. So a bunch of motley group of cash stocks doing extremely well, even as the markets are slightly under pressure, though recovering. What we'll do is take a short break on that note, wrap up on this edition of Chartbusters. But as we do wrap up, here's some good news for you. To Nigel's right, you will see that a phone comes up because that's where the CNBC-TV18 app is. India business news leader is now just a click away. That's the all-new CNBC-TV18 app. You use your phone, you get instant access to all the in-depth analysis, news, articles from the financial world, updates on your fingertips. All you got to do is download this app on either the Apple Store or Google Play Store, depending on the operating system that you use on your phone. And then go ahead, use that, get all the updates on your fingertips in real time.